Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. And this week's topic, guys, is one I haven't done in quite a while. It's probably been a good 2 years since I've done this topic, and I think it's one of the most important ones that you can learn in trading. No, it's not money management, because that's number one. It's how to eliminate bad trades. I'm noticing a lot of you folks out there, even the ones that have decent money management, what you're doing is you're making money Monday, Tuesday, Wednesday, Thursday, and then Friday, you're giving it all back. All right, or you'll start off the week on Monday down so much it takes you all week to get it back. Well, we're going to go more granular than that, okay? We're going to go dig deep into candlestick charts today and look at why you're taking bad trades, okay? So we're going to dig inside those red and green candlesticks, okay, and see what the bottoming tail means, what the topping tail means, how they look in the bigger context of the chart, so you can stop taking shit trades, stop taking crap trades. I'm seeing it all the time, people DMing me, people emailing me, they're like, Jared, this trade didn't work, why? And I look at it and I'm like, because it's garbage. Why are you taking those trades? So we're not only just going to talk about candlesticks, we're also going to merge those candlesticks with multiple time frame analysis so that you guys are always looking at a couple time frames above your entry and a couple time frames below your entry, so that you're never going to be on the wrong side of the market, never on the wrong side of the stock, and never on the wrong side of your bias. So we're going to merge that multiple time frames with actually good charts. So I think it's one of the more powerful lectures I've done in a long time. It's called Eliminating Bad Trades. Guys, if you like these videos, please help me out by clicking the like button, hammering the subscribe button. All right, I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is eliminating bad trades by using multiple time frame analysis. We're going to dig deep today. We're going to go granular today. We're going to not only look at individual candlesticks, we're going to look at how those candlesticks change depending on whether you're looking at a time frame above or a time frame below, and how not looking at the bigger picture can be an extremely costly venture. So I'm seeing frequently, in fact, even in the chat room today, where traders, and Unwall, I think, even just alluded to this a second ago, where traders are looking at something in a vacuum and they're going, hey, on the 2-minute chart, what do you think? Well, I don't care, if it looks like a Victoria's Secret model on a 2-minute chart. If it looks like a pig with lipstick on a daily chart, that's what we go with, right? Period. Are there times occasionally you can get away with what I call vacuum trading and not looking at the higher? Yeah, every once in a while you'll get away with it, but it's not a long-term solution to this. So we're going to help eliminate bad trades by looking at multiple time frames, as well as looking at individual candlesticks. So I think, in my opinion, I think it's one of the more powerful lectures I've done in a while, because we're going to talk deeply about candlesticks, and I think it will help a lot of you guys with your trading. But before we do that, we need to talk about, when will the insanity stop? My goodness, there's so much insanity out there. Like, every week I think to myself, you're not going to find anything this week, Jared. You won't find anything. No one will send you anything. No, it's just not going to happen. And every week, sure as shit, several of them come in, either through email or I find them in my searches. And this week's, nothing is really as bad as last week's, but this week's is also pretty bad, okay? And this week's has to do with Bitcoin. Okay, and maybe some of you guys saw this article out there. Man bets life savings on Bitcoin and loses everything. So before we even start, okay, I know that you Bitcoin folks and crypto folks, you're a cult. Flat out. You guys are like an Antifa cult, okay? So I'm not out here trying to tell you not to trade Bitcoin. I don't want my house burnt down, okay? I'm not telling you not to trade Bitcoin. All right, because I know you people are crazy. But that aside, this could be related to Bitcoin. This could be related to options, stocks, Forex. It doesn't matter. Never, ever, ever bet your life savings on one thing. All right, that's it. I mean, I don't want to be mean to this particular person, because I'm sure it's hard enough losing their life savings. But come on, man. Really? Your life savings, I mean, it's incredible. So the point I want you guys to take from this, because I'm not going to spend as much time on this, because I think you get it. Man loses life savings on Bitcoin, loses everything. Over the course of a decade, the couple, husband and wife, had worked hard to save as much as possible, taking odd jobs here and there. So up until this Bitcoin debacle, this person had the right attitude. They were saving, they were taking odd jobs, and doing whatever was required and necessary to save a little bit of extra money. Awesome. And then you do this. Come on, man. Like, really? Okay? So, and I laugh, but it's not funny. I mean, this person still hasn't told their wife yet. Now, granted, this article was, a week ago or a few days back, but why? Probably because it's too hard. So the lesson to learn here is, one, don't be stupid, right? That's every week's lesson, but it takes you a decade to earn it and a week to lose it. A decade to earn it and a week to lose it. So whenever we're in the chat room and I go, it's not for me, guys. When somebody says, Jared, what do you think of GameStop today? YOLO, diamond hands. I go, guys, I would rather do it slow and steady but guaranteed than try to get rich quick. But I know many of you out there watching this, you're not going to give a shit. You're doing it right now. You're bag holding AMC because you own it at $70. You're bag holding GME. You're bag holding because that's what people do. And you want to know why the 1%'s the 1%? Because they're the 1%. You can be jealous of them all you want, but they're there because they generally make smart decisions. No, I don't want to hear, oh, he's a trust fund this and that person's a... That's a much smaller percentage of the 1% than you think. Okay? They're there because they make good financial decisions. You need to also. All right, let's move along. All right? So, we're going to talk a little bit about multiple time frames. Okay? When all time frames are in alignment, trading odds increase, but this rarely occurs. Trend analysis teaches you an objective method to determine what the trend or the stage is. This is true at the top. Okay, it's really, really hard to get all time frames. Say you're trading on a 5-minute chart. You want to get the 1 minute, the 2 minute, the 15, the 60, the daily, all in alignment with the market. That's a challenge. So we're generally speaking looking for the daily time frame is our bias, and then the lower time frame is our entry time frame. So you must decide what time frame you will trade in and which you will gain a long-term bias from. Now, if you're a swing trader, your long-term bias might come from a weekly or a monthly chart, but your entry time frame might come from a daily or a 60-minute chart, right? If you're a core trader, your long-term bias might come from a monthly or a yearly chart, and your entry might come from a daily or a weekly, occasionally a monthly, right? So notice we're always going several time frames above to get the bigger picture bias, okay? And the analogy that I generally use for this is looking at the forest from the trees. You see, if you're in a forest, call it the Amazon rainforest because it's so dense, and you're on a tree, okay? And you're looking at the leaves, and you're looking at the bark, and you're looking at the branches. Guess what you're not looking at? The big picture. So the forest could be on fire a mile away, 2 miles away, and you wouldn't even know it because you're so focused on the leaf in front of you, the branch in front of you, the bark in front of you, the tree in front of you, that you haven't looked at the bigger picture. So as an intraday trader, the bigger picture is the daily. As a swing trader, it might be the monthly. But take a look from above on a helicopter. Look down and go, wow, what the heck's going on around me? Stop looking at just your entry time frame. Okay, it's unbelievable. If you take nothing from this lecture today, take this. Stop only looking at your entry time frame. Look at the bigger picture bias as well. Okay, so then you're going to apply that and then drill down into the tree. Once you know it's safe, then you can look at the bark and the leaves and the branch of that tree. Okay, but until you know it's safe, you can't do that. So use that analogy. Now, let's take a look at some charts because every slide from here on out is charts. All right, that's it. So we look at this and what do we see? All right, I'm not asking, I'm just kind of showing it out there, right? You take a look at this and you're like, all right, moves up, pulls back, moves up, pulls back, moves up, pulls back, moves up, consolidates, moves up, pulls back, moves up. I mean, this looks like a pretty darn nice uptrend, right? You have not really a double bottom because it's a lower low, but you put in a higher high here and a higher low and a higher high and a higher low and a higher high and a higher low and a higher high. I mean, it's like a perfect uptrend, right? Buy set up here, maybe a little mini breakout there, a little buy set up here maybe, a little buy set up there. Okay, we see a stock in an uptrend. Okay, it looks like the stairway to heaven, right, as somebody says. Okay, now I'm going to block it off. All right, so I've taken that same chart and I've just cut it in thirds, right? I've taken it and I've cut it in thirds. You're like, well, why would you do such a crazy thing like that? Because it's not what you think it is. This is not what you think it is. Okay? But you're going to learn a lesson that things look different in different time frames, which makes them more or less tradable. You're like, well, geez, Jared, that was a nice way to say nothing. Okay, you're right, it was. All right? The point simply is sometimes we have to move up and sometimes we have to move down to get a better entry in the bigger picture. Okay, but before we do that, I'll show you what I mean. Different time frames provide different pictures. So on the left, we have a 2-minute pullback, right? Lower high, lower high, lower high, lower lows, lower lows, lower lows. Same information, different time frame. That's important to note. Same information, different time frame. So this is a 2-minute chart. This is the exact same 2-minute chart, but how it might look on a 5-minute chart. So the pullback right here, right? Because right here you have 2, 4, 6, 8. Right here, this right there, those are those 2.5 red bars. Red bar, and then there's a third red bar, which would be 6 minutes. But take a look at the 5-minute. Red bar, and half of this red bar. And then this pulls back, and then this bar comes in, and then another bar and another bar. My point is yes, we're missing a bar or two here, right? Could there be another green bar up here, right? And we could probably easily just do this, right? And do this, and make it even more so, okay? So the point simply is how things look on different time frames. Okay? So these 2 to 3 red bars are one big bar on the 5-minute, but they're actually nice sequential pullback on the 2-minute. And then this big engulfing green bar, you might have part of a red bar inside of this that gets engulfed by a green bar and then another green bar. So you have a turnaround bar here on the 5-minute, but you have a buy setup here on the 2-minute. All right? When you get good at trading, what will happen is you'll be able to know, or at least with 80 to 90% accuracy, guess what the higher and lower time frame already looks like without even looking at it. Now, you should still look at it, okay? But the point is we're going to dig inside the candlesticks today. And you can see here on the 2-minute, it's a buy setup, and on the 5-minute, it's a turnaround bar. Okay? Why is this important? Because when you look at higher and lower time frames, you have to immediately think to yourself, well, what does that look like in a lower time frame or in a higher time frame? And also, you might be able to justify a possible ad that you could not have justified before. Right? So, for example, you might take this 2-minute buy setup, and then you would never buy this right here, right? You would just never buy that. But then you look and you're like, wow, it's a turnaround bar. Now I can actually justify buying some more. All right. Now that obviously depends if you maxed out your money management. You might not be able to add, but you understand the point. You might have an opportunity to add here that you otherwise wouldn't have had you not looked at the 5-minute chart. And on the 5-minute, if you hadn't looked at the 2-minute, you might have gotten a better entry on the 2-minute chart, but you never looked at it, so you had to take the turnaround bar entry, which is not as good as the 2-minute buy setup entry. See where I'm going with this? Like both sides here. Sometimes you can add to a position and make it a good position better, and sometimes you can take a position that's decent but make it better by drilling down and getting a better entry. All right, so there's a lot in there, okay? But now here we're going to go back, okay? Now we're going to do this. Remember this? You just saw this slide. Remember it? Watch for it again. What? No, you didn't. Yes, I did. Do you guys remember this? I took the same chart on 3 different time frames. Literally, I did. I took it on a 15-minute, a 5-minute, a 2-minute. I just strung it together. And you didn't know it, did you? You had no idea. It's the same chart cut in 3 pieces, and they're all different time frames. One of these is a 15-minute, one of these is a 5-minute, one of these is a 2-minute. And this is what it looks like. Okay? Again, why is that important? Because you see different pictures on different time frames. So when you look at the 15-minute right here, see where this arrow goes up? That's what that engulfing bar, see that red bar and green bar right down here in the pink box? That's what it looks like on a 5-minute. So on a 15-minute, you're looking at that and you're going, yeah, I don't know if I want to do anything with this. It doesn't look that good. But once you drill down to a 5, you're like, well, it does have a higher pivot high, and it is pulling back to some support right here. Interesting. Lower high, lower high, lower high, doji bar, narrow body bar, change of color bar, lower lows. Maybe I buy that. Maybe you don't. Maybe it's still too aggressive for you. But the point simply is the different picture that you're seeing might allow you might be hot to trot on this stock, and you might say, you know what, I have to find an entry in this. So you might say to yourself, well, this isn't a good enough area for me to get in. But then you drill to the 5 and go, you know what, I don't want to go full yet, but I'm going to take a third lot here or a half lot here because I like this gap so much, and I like this stock, and I like the relative strength. And as it moves up, you're saying to yourself, there's no entries right here. See this little orange, yellow area, whatever it is, right? Overlapping over, and you're like, there's nothing there. And then you drill down to the 2-minute, oh my gosh, like it's a perfect buy setup. Now I can get full. So you start out with, mediocre down here in the bottom. It gets a lot better when you drill down to a 5. You enter some, maybe a half lot. It starts to move up, and you're like, shoot, where am I going to get my entry? The stock's 4 bars up. There's nothing I can do. It's a 1-bar pullback. Oh. Drill down to the 2, and you're like, wow, lower high, lower high, lower high, bottoming tail, narrow body bar doji. I'm going to get full here, and I'm going to raise my stop maybe up under that area right here, or maybe you keep it down there. But you're seeing a different picture once you drill down, a picture you would not have otherwise seen had you not drilled down. You would have just looked at the 15-minute chart and be like, there's nothing here, there's no entries. Guys, give me another, if you can think of it. For those of you that have taken professional trading strategies, give me another scenario in which we do something similar to this that allows us, hint, hint, that allows us to jump in stocks early. What's another similar, it's not exactly the same, where if you've taken professional strategy, it allows us to jump into a stock really early in the morning? Anybody? Well, that's just a 1-minute high, though. There we go. D and Michael. We use pre-market charts, right? How many times, when you see it in professional trading strategies, how many times do you see a gap that you really like? You really like it. And then it just rips right at 9:30, 9:31, like gone. And you sit there and you're like twiddling your thumbs. You're like, wait a second. I just spent 30 minutes, 40 minutes staring at that in the pre-market. And as soon as the bell, bing, ding, 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 stock's gone. It's up $4. Well, in those scenarios, we use high-level gaps with pre-market charts. We'll look at a 2-minute pre-market base. We'll look at a 5-minute pre-market buy setup, and we'll nibble some early so we don't miss the move. In a sense, this is what we're doing. We're sitting here looking at a 15-minute chart that maybe we like the daily a lot, and we're like, yeah, but there's not a great entry on the 15-minute yet. But the 5-minute provides us with a better entry. And then the 2-minute provides us, it basically provides us with a way to get involved in this stock in a reasonable area with a decent pattern. Okay? So let's take a look at a different angle now. Okay? All right. So now, we're in a micro chart right now. Okay? We're in a micro chart. So, stock gaps up, moves higher, pulls back, retests. Pulls back, retests, and then goes lower. Notice the moving average. We've broken below the moving average. We've bounced. We've gone lower. We've bounced. Guess what? We're technically speaking very close to a stage 4 downtrend. Are we not? On a micro time frame. Okay? Now, obviously, this is a 2-minute chart. Okay? We are not in a bigger time frame downtrend. How do I know this? Because of the 200 period moving average there. But take a look at this. You're far from the moving average. Okay? You put in a couple tops, you consolidate back towards the moving average, and it doesn't go higher. It fails. Now you have to assume on a micro time frame, this is a double top stage 3 retest and failure because it tried to go higher and couldn't. Okay? And then what happens? When you break below this area right here where my cursor is, you are in the transition between stage 3 and stage 4. You're not in a stage 4, but you're not in a stage 3. You're between stages. But the one thing we do know is it's not bullish. It's not bullish on the micro time frame, right? So we go lower, 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 lower. We bounce up. Where are we? We're under the moving average right now, guys. We're under the moving average. Notice where we bounced. You guys remember from PTS? The floor becomes the ceiling. This used to be support right here where my cursor is. That used to be support. It's now resistance on the way back up. Okay, so we're below the declining moving average. We've bounced back into newly formed resistance, and then we go lower, 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 lower. Now what do we also do? We're staying below the moving average. We put in a new low to the day. Not by much, very, very little. But now you have an argument. We have a lower high right here, and we have a lower low right here. We have another lower low right here, and another lower high. What do we have? Two lower lows, two lower highs. We are officially in a downtrend. Two lower lows, two lower highs. So now we're sitting there going, I'm following the book, Jared. I'm doing everything you said to. I am reading this chart like a master, right? I'm a Zen master. Double top, broke support, below the moving average, in a micro downtrend, and you're like, I'm shorting it. Can't wait to send this one to Jared. Can't wait to make my money, then send this one to Jared Aftermarket. I'm going to email him how beautiful of a stage 4 2-minute sell setup this was. Good trade. Was it? Is it a good trade? Well, it triggers. We know that, right? You can see these two bars here. So, vacuum trading tells me it's a good trade, right? Vacuum trading says get in this, short it. Multiple time frame analysis trading says, what the heck are you doing? Right? Multiple time frame analysis says, stop, pump the brakes. You're not going to short this stock. You're going to buy it. What? You're going to lose your Zen master credentials, right? If you don't look at the higher time frame, okay? I haven't used this, Braden, in 18 months. I haven't used this in 18 months, Braden. I know because I have the date on the last time I taught it. Okay, so when you say quite a bit, maybe you're just watching it over and over again. All right, so gaps up, pulls back. There's the green line. There's the pivot. There's the topping down. This is where support is, in this $62 area. Now you have a bottoming tail near support, near the low of the day, okay? And you're getting a buy setup entry. The failure of a pattern in a lower time frame confirms the entry in a higher time frame. Okay? But hey, if you want a vacuum trade, you can short it. What happens is, when this sell setup fails, it triggers the buy setup over here. Okay? Hello. Wow, powerful stuff. Okay? So there it is. There's the failure of the sell setup right there on the green bar, all the way over here. Triggers the buy setup. You done messed up. Right? You messed up. Now, even if you choose not to take the buy setup, you're still not going to short it right here. That's the key you need to learn. Even if you choose not to take the buy setup for whatever reason, it will eliminate you from shorting this over here. Okay? So we've just eliminated a bad trade by looking at the higher time frame. Right? We've just eliminated a stupid trade by looking at the higher time frame. Okay? Now, what about this? This is granular, drilling down a little bit deeper, right? The higher time frame kept us out of this bad trade. It keeps us safe. So the 2-minute sell setup failure signals the buy setup entry. Okay? It's important you guys learn this. Okay? It's very important you guys learn this. Because if you don't, you're going to be taking a lot of crappy trades. All right? Using multiple time frames will not only help you pick your targets better, it will help you pick your stop losses better, It will help keep you out of bad trades more frequently and more often, okay? And it's going to generally make you a better trader because the higher time frame is more reliable than the lower time frame because it's the same amount of information over a longer period of time, which means there's more or less commitment there depending on the direction you're looking at. Okay, so these things are very, very, very important. All right, and I'm bringing this out there because we have PTS coming up. We're going to dig really deep into this, really deep. Like, this is basically 2 slides, right? It's a 2-minute chart and a 15-minute chart. I've added a bunch on this topic. Why? Because what I've done, and I think I told you guys, I've seen all the questions that people ask over the years, and I think they're obvious, but obviously if that same question is being asked, it's not as obvious as I thought it was. So I've added so much more to that, all right, so that people can better understand it with more examples, breaking down candlesticks, looking at higher time frames and lower time frames, okay? In terms of breaking down candlesticks, Professional Trading has a whole chapter on breaking down a candlestick. All right, 30 slides on just breaking down candlesticks. This is a little different. We're not just breaking down a candlestick here. We're breaking down time frames, right? We're breaking down time frames. And like I just said, it will keep you out of a bad trade. It will also help show you where more significant areas of resistance and support are so you can better appropriate your stop losses and your targets. Right? Some of you are looking at a target area that's either too close or too far away because they're not looking at the higher time frame. We're also going to focus on when an area is finished, right? When a stock is traded above or below an area, that area is now considered gone. So these things are really, really important, okay? And you guys need to understand them. We're also going to talk a little bit about extended moves in higher time frames. So we've looked at this chart in the past. It's been a while, okay? But if you look here, a stock gapped up and moves higher, puts in a lower low, puts in a bottoming tail, bounces, goes lower, bounces, goes lower. Okay, and then we're going to look at these retests and failures. And remember, we're going to look at this in the context of multiple time frames because you might look at this on a 2-minute and you might say, wow, yes, Jared, that's a retest and failure. And yes, it should bounce here. But it's too aggressive to trade right here. And I would agree with you. If we're looking at a 5-minute chart, say this is a 5-minute chart, and I'm looking at this and go, wow, yeah, that's too aggressive. But what if we looked to the left and on a 60-minute chart, there's like triple bottom support with a rising 200 period moving average at this exact same area? Might change your opinion of this area, might it not? See, we already know, right, that we're on a little retest and failure here because it retested and it didn't go lower. But it's also a very aggressive area with some slop above to the left, right? There's some congestion here. So you would generally stay away from this. But if you look to the left and there was a 60-minute triple bottom support area with bottoming tails at a rising 200 period moving average, you might be inclined to take a partial position here. And then when it puts in that higher high and pulls back and puts in a higher low, then you get full on it. Okay? So breaking down the chart is important, right? In a vacuum, it's important. But if you're not looking at the higher and lower time frames, you're just doing yourself a disservice, right? You're not giving yourself the full picture like the analogy suggests. You're looking at the forest, but you're only looking at the branches and the bark, and you're not looking at the whole picture. And it's fascinating to me why more people don't look at the bigger picture. And I got to ask, is it really that hard, guys? Let's just take the slide in front of you, right? This slide. Take this space here. Is it that hard to put 4 charts on this space? Is it that hard at the top left to put a 2-minute chart, and then in the top right put a 5-minute chart, and then in the bottom put a 60-minute chart, and then a daily? Is it really that hard? Because people always go, well, how do you look at multiple time frames? You put them on charts in front of you. I don't think it's that hard. You put a 2-minute up there, a 5-minute up there. You put a 60-minute down here and a daily down here. Now, every time you look at a chart, when you're scanning, and you're like, I want to know what JKS is doing. Boom, JKS populates on 4 different time frames. PDD populates on 4 different time frames. What's the problem? It's pretty simple, okay? It's pretty simple, okay? So I hope that you guys learned a little bit about drilling down into lower and higher time frames, and also when to stay out of a trade because the higher time frame suggests you should. In professional trading strategies, there are many more examples of this, especially the new version of it. I am Jared Wesley of Live Traders. We'll get back at it again next week.